Hey guys, it's day 9. What I want to talk about today is how do you actually invest in promissory notes? So it's kind of cliche, but you've heard it before where you're finding them, and flipping them. So step one is finding them. I contact banks directly and I just talk to their asset manager, seeing what they have available and what they need to get off their portfolios, what they need to get rid of as far as non-performing. Then I can also call hedge funds. Hedge funds are usually made up of different investors or companies, and they use crowdfunding to buy big pools for themselves. And they cherry pick those lists and kind of let out whatever is not fitting in their criteria. So hedge funds is number 2. 3 is networking with other private investors like myself who may have things in their portfolios again that don't fit their criteria or they're just tired of holding on to and are ready to sell off. And then finally, it's with for sale by owners in the sense of owner finance notes, seller financing notes, notes that were generated by someone who may have 2 or 3 homes. They offered a lease option or some kind of seller carryback on a note, and they just want to cash out and move on. So step one is finding the notes. Step two is funding them. So as I get these notes in, as I get these assets in, I do some preliminary due diligence, make sure the numbers look good, run my numbers, and then I send them out to my JV partners or my funding partners, and I categorize them as 2 types of investors. You have your aggressive investor and your passive investor. And the titles don't mean anything, it's just how I'm calling them for today. So your your aggressive investor is someone who is a full-time real estate investor. They're in between deals, they're always looking for deals, they have deals, and they're just looking to do a quick turnaround on their money. They understand the terms, they understand the returns that you can get, and they're always looking for the next deal to join up with. The other one is what I call passive investor, and that's just your normal everyday W-2 worker, somebody who's been at a job for 20, 30 years. They're just looking to build up their nest egg so when they retire they have something tangible in their savings account. They understand that the terms and the returns again are something that they're going to have greater over a 12 to 18 month return than they would on a CD, their savings account, traditional types of stocks, and what they're going to not even see in 3 to 5 years off of that. So finally, we look at the flipping part. The flipping part is basically once we agree, we make these offers, we get the bids in, our bids are accepted, then we use our third-party vendors to reach out to the borrowers. We use one of about 15 different exit strategies, and I say about 15 because as the years go on, as the economy changes, there's some programs that are available, not available. There's money in these programs that are there, not there anymore. So just depending on what we have, but we always have more than one way to get our money back. So once we get our money back, we give back the seed money or the initial investment money, the purchase money to our investors that we borrowed in the first place, and then we give them their share, whether it's a split or it's an interest that we agreed upon, and then we just rinse and repeat. So again, the 3 tips or the 3 steps are finding, funding, and flipping, and that's how you get into the note business.